A very good morning to all of you students. Today we will be discussing the revisionary aspects of mergers and acquisitions and startup finance. So let's start with the first topic of mergers and acquisitions. So just to start on a revisionary note. So we'll first cover the concepts part. Then we'll also do a couple of the case scenarios, and then we'll also cover the of merger and acquisition was where that, let's say there are two companies which is A and B. Okay. Okay. Let me start again. So, good morning, students. Today we will be covering the revisionary aspects of mergers and acquisitions and startup finance. So, we'll be going through some of the topics. We'll be going through some of the concepts, and we will also be covering the case scenarios. Okay. So, let's first start with what are the different types of mergers and acquisitions. So here, in the first case, let's start with taking two different companies, A and B. So the company A is actually the one in which company B is getting merged into and it is getting dissolved. So the company B gets dissolved. So that means there is no separate legal identity of B that is left after B gets merged into A. So this is called as a merger, right? Wherein the business, the assets, the liabilities of B are getting transferred to A, and A will continue the entire business in its own name. Okay, and A actually emerges out from the merger. So this is called as a merger. Now, second type of merger and acquisition can be where are, again, let's say there are two companies. One, there is A. Second, there is B. Now, what does A A does is A actually takes a majority stake in B Limited. Okay, by majority stake in B Limited, let's say 51% or more, wherein they have the controlling power. They can control the decision making of B. Okay. In such a case, the A will become holding company and B will become subsidiary company, right? And in future also, the A will continue as a separate legal identity and B will also continue as a separate legal identity. B is not getting dissolved. In the first case, B is getting dissolved. In the second case, B is not getting dissolved. B is getting continued on an as is basis. So this is an example of acquisition wherein the majority stake is getting acquired, the business is getting acquired, and hence the another type of merger and acquisition. Clear? Third type is where we have a company called A and it has different businesses. Let's say it has a business one of FMCG business and business two, let's say of a real estate business wherein they develop the, let's say, residential societies and they sell it. Okay, so there are two different businesses. Now both of them were getting operated under A. As a next step, what they decided, they said that okay, for B2, because both of these businesses are totally unrelated to each other, so B2 will be handled by a new company incorporated as B, and B1 will continue with the same company called A. So this is a split, right? This is a split of the business that is happening. Okay. So this is also one kind of merger and acquisition. Here the business are getting split up and a new company is getting formed for the unrelated business. Then the fourth one, wherein there are two companies A and B. Both of them are getting dissolved and merged to emerge as a new company called C. Clear? So in this case also, the merger has happened and there is a new company that got created, C, in which the entire business got transferred. So student, if you see, the purpose of introducing these four different cases here is to say that just don't go over the legal form of what the name is. The structure may be such that it will lead to a merger and acquisition, right? And it can happen in any way. It can be a deconsolidation, it can be a demerger, it can be a merger, it can be an acquisition, it can be a split up, it can be many many things. Okay, perfect. So so this was it. Then let's take the first scenario in this, right, which is the most common one, wherein there are two different companies. One company gets merged into another company. So here B is getting merged into A, and A will pay purchase consideration to B's shareholders. Okay, because B is getting dissolved. Now, that purchase consideration can take different forms, students. The first form can be equity shares of A Limited issued to the shareholders of B Limited. So, what is happening here? So, we are saying that we are issuing shares in exchange of shares. Okay, these are shares in exchange of shares. Now, see, first of all, we are trying to answer that if B is getting merged into A, then there will be some amount of consideration that will be paid by A to B. Now, what can be those different forms and type of those considerations is what we are discussing. So, the first type and form of that consideration can be in the form of equity shares of A Limited, right? But the point to note here is that those will be issued to the shareholders of B Limited. Those will not be issued to the B Limited itself. Why? Because the ultimate ownership of B Limited lies with the shareholders. And once B gets dissolved, the shareholders of B Limited will forego their right in B Limited. So, for foregoing their right in B Limited, they will get the equity shares of A Limited. Okay, so this is one form of the settlement. Second can be a outright cash payment. By cash payment, here we mean that the funds are paid to the shareholders of B Limited. Yes, Saminathan, you are correct. These are the different forms that you have mentioned. Very good. Then the last one can be a mix of one and two, wherein some form of the consideration is being paid through cash and some form of the consideration is being discharged through the issue of equity shares to the shareholders of B Limited. Now, the question comes that if the settlement is happening in the form of shares being issued to the shareholders of B Limited, then what is the exchange ratio, right? What is the exchange ratio? So, for how many shares of B Limited, how many shares of A Limited should be issued. So there has to be a linkage to it, right? Because B Limited shareholders will want to maximize the shares being issued by A Limited, and A Limited will want to minimize the amount of shares that are issued to B Limited, right? Because while paying, I will try to negotiate lower, while receiving, I will try to negotiate higher. So we'll have to define a swap ratio. So swap ratio is defined as the number of shares being required to be exchanged. Okay, that is what it is. A swap ratio is. Then, in case we're talking about the cash payment, we'll have to understand what is the value of such payment, right? Then the last will be mix of 1 and 2. Now, for understanding the value of the payment, we'll have to see that what is the right valuation, and hence B Limited will be seeking a higher valuation, A Limited will be seeking a lower valuation, right? Now, in the entire, so we'll go through how to compute the value of such payment, how to compute the swap ratio, and how to effectively assess whether the merger and acquisition is a good one or not. Okay, so in this entire topic, students, we are discussing about these four major parts. One, the estimation of the A Limited's equity, right? A Limited means the company in which the other company is getting merged into. Okay. Then estimate B Limited's equity. So first of all, we need to understand that what is their net worth, what is their equity value, right? At both the companies' end. Because if we have to arrive at a transaction, or we have to arrive at a swap ratio, so it will be swapped in some mathematical manner, right? Which is, let's say, their equity value, their EPS value, their market per share value. Okay. And lastly, there is some post merger analysis as well, wherein we will see whether the price at which they have done the deal later on, it is making sense or not. Whether they have purchased cheaper, whether they have purchased on a premium, clear? And hence, what impact will it have on the post merger EPS, on the post merger MPS? All those things comes into this part. Okay. So the PE ratio is actually given by price divided by earnings. So this we already know. We are just revising the formula. The PE ratio is also called as the PE multiple. So which is basically telling you that for 1 rupee of earning, what multiple gets into price. Simple. So if let's say PE ratio is 7, so for every 1 rupee earned, your market price will be 7 times the 1 rupee. Okay, so it is telling us that what is the price on such earnings, right? And hence the multiple. So this is useful, students, in case out of these three, two are given, the other one can be found out through this equation, right? And this can also be rewritten as price is equal to P ratio into earnings. Right? In case we need to find out the price, it will be P ratio multiplied by earnings. And in case we find out the earnings, then it will be price divided by the PE ratio. Now, students, let's come to the discussion of swap ratio. Right? How do we calculate the swap ratio? Now, there are different ways to calculate a swap ratio. The question will specify that which specific case we will have to use. So the first one is basis the market price. So let's say the shareholders of A and B feel that the market price is the most relevant metrics to arrive at the swap ratio. So they will use this formula to calculate how many shares to be issued, which is market price per share of B limited divided by the market price per share of A limited. These are market price based, students. Okay. So simply in the numerator, we will take the target company's market price, and in denominator, we will take the acquiring company's market price. On EPS, this is basis earnings. So earnings per share for B limited again divided by the earnings per share of A limited. So the again please do remember B limited is the target company. Okay, is the company which is getting acquired. So if let's say the shareholders say that we place a good amount of weight on earnings of a company, EPS of the company, they will use this swap ratio. Clear? There are different school of thoughts. So somebody says that the earnings is what is reality as of now. Market price may be having some of the influence on account of the market demand and supply. But someone says that market price is something that I will get if I will sell it today. Or if I'll have to purchase it, I will purchase it at market price. So for us, we will have to apply basis two things. One, what is given in the question. Second, what is specified by the question. If let's say the question is not giving you anything on EPS, it is only giving you MPS. So definitely you will calculate the swap ratio basis MPS. Or if let's say the question is giving you both MPS and EPS, but the question says that you'll have to calculate the swap ratio basis MPS, then you will calculate basis MPS. Clear? So, and also one more thing. Sometimes the question will say that okay, you put a weights of let's say 60% to MPS and 40% to EPS. In that case, you'll have to calculate differently and then apply a weighted average number. The third way to calculate swap ratio is actually the book value per share, students. So the book value per share for again B limited, which is the target company, divided by the book value per share of A limited, which is the acquiring company. So book value will be computed how? By using their balance sheet numbers of assets minus liabilities, right? Then there can this is a very specific instance. Okay, this is a very specific instance on NPA, which is non-performing asset. So for banks, students, what happens? There is a non-performing asset. So whatever loans that they have given, if they are not able to realize the installments, they are not able to realize the principal and the interest payments for some time, then as per the RBI guidelines, they will classify those as non-performing assets. Now, let's say there is a merger happening between two different banks, Bank A and Bank B. Now, both of them have a loan book value, right? A loan portfolio that they would have given. Now, within that loan portfolio, they will also have NPA percentage. Let's say how much percentage of that loan is a non-performing asset. For example, the bank A says that it has a 5% NPA in its balance sheet. On the other hand, B says that they have a 20% NPA. Okay, 5 and 20. So 5 for the bank A, which is actually the acquiring bank, and 20 for bank B, which is the target bank, which is getting acquired. So if we just use the above formulas, wherein the target companies in the numerator and the acquiring companies in denominator, so it will result into what? This is the ratio 20 by 5, which is 4 is to 1. So that means 4 shares of A limited banks will be issued. But don't you think this is a wrong picture wherein we are paying higher shares for a acquisition of higher non-performing assets? Ideally, we should pay lower amount of shares for acquisition of a bank which have a higher non-performing asset, right? So in this case, we reverse the equation, right? We reverse the sequence of the numerator and denominator. So if you see, while we have been asked to calculate on NPA, so we will take the NPA of A limited first in the numerator, then NPA of B limited in the denominator. I hope this is clear, students. I've explained the logic that why we should not take the other orders that we have discussed, because then it will lead to a higher amount of the swap ratio, students. I hope this is clear. Perfect. So then let's move to the next part. Now, EPS. What do we mean by EPS? Earnings per share. So, whatever earnings are attributable to the equity shareholders, that is taken in the numerator divided by the number of equity shares in the denominator. This will help us to calculate the earnings per share. Now, the question will sometimes ask you to calculate the EPS post merger or EPS after merger. Okay. So in that case, we will have to take into account two different things. One, in case, let's say the settlement is happening through shares, the purchase consideration is for the issuance of shares. So what will happen, students? So first of all, if the merger is happening, right, they will have now a consolidated profit after tax of both the companies. This is a very basic point. Plus, they will also have some synergy gain. So I will explain this later. As of now, I will explain this later. As of now, just assume that this is an extra gain that comes once the merger happens, right? Apart from the operational, or let's say the regular part of A and B, this something extra will come, which we call it as synergy gain. Okay, so I will explain what is this in subsequent slides. Now, in the denominator, we will have equity shares of A limited and equity shares issued to the shareholders of B limited, right? So we will have both the things. Sorry, because this is a case of the share settlement, This will be extra, right? This will be the shares that are issued extra to the shareholders of B Limited. Clear? So this is the post-merger EPS that will come in. Now, if let's say the payment is happening through cash, right, which is the second method. So again, we will say the part of A, the part of B, and the synergy gain, right? This is the collective earnings that will happen post-merger. From this, we will also have to reduce whatever cash has been paid on that, what is my opportunity return that I would have earned, and on that 1 minus T. So this is a opportunity gain sort of a thing. Right? This is a opportunity gain. So had we not paid this cash to acquire the company, we would have earned a return on that, now which we are not able to get it, and hence we are reducing it from the overall pool. Please do remember, if the tax rate is given, sorry, since we are taking PAT here, which is after tax numbers, so here also we will take after tax 1 minus T, students. And this whole divided by the number of equity shares of A Limited. Clear? I hope this is clear. One more thing, students. We have not added here like the new equity shares, because in the second case there is no new equity shares that has been issued. There can be a third case also, students, here. The third case can be partial share settlement and partial through cash. So then both the formulas will get merged. In this, this will remain as is. In this, we will just reduce the cash paid on that, whatever return we would have earned, that also we will reduce. Yes, perfect. So reason we paid by cash only, hence share of B Limited not there. Yes, yes, Saminathan, you are correct. Okay. So in case the combined situation is also given, so that also we know, we will take the numerator and denominator accordingly. In denominator, we will add the number of shares that are issued, and in numerator, we will reduce whatever amount we have paid in cash on that, whatever return we would have generated. Yeah. Now, this was the EPS post merger. The above will help us to calculate that what is the EPS post merger. Now, if somebody asks us to calculate the effect of EPS post merger, then what we will do for the A Limited company, right, which is the acquiring company, the post merger EPS we will just mention, and the pre merger EPS we will reduce to show the impact. Right, we will just compare the pre and the post merger EPS in a simple manner. Right, that's a simple comparison. But when it comes to the target company, right, so here we will have to compare the EPS of A Limited post merger with the EPS of B Limited pre merger, right, because that is where we will be able to analyze the impact. So let me say here, let's say, so this is what? This is A Limited, let's say. This is B Limited. Okay. So let's say EPS of A Limited was 100 rupees, and here it was, let's say, 50 rupees, or let's take 80 rupees here. Okay. So this was the EPS. Swap ratio was agreed as 2:1. Let's say 1 is to 2. One share for every two share held. Okay. And post merger EPS is, let's say, 200, right? Can I write it as 0.5 is to 1? Yes, I can write this. Correct? So 1 is to 2 is 0.5 is to 1. The post merger EPS is 200 students. Now what we will do? We will calculate the impact of merger on EPS. Now, if you think from A Limited's perspective, nothing has changed. One share was earlier valued as 100 rupees. Now, one share is valued as 200 rupees. Not valued, but the EPS is 200 rupees, right? So, the EPS have increased. Now, this is pre merger, this is post merger, right? And hence, there is a gain of 100 rupees, right? Per share. Now, if we talk about from B Limited's perspective, so post merger, there is no B Limited, there is no B Limited, right? So for A Limited, the value is 200, but this is not representative of the fact that entire one share belonged to B Limited's shareholder. Just a second. Let me share the screen again. I think there is an update in the application. Just give me a second. It's happening. Sorry. So meanwhile, it is getting updated. The point that I was trying to make is that it is okay that A Limited's EPS have gone up, but it is not, let's say we cannot compare 280 rupees is what I'm trying to say, right? 80 was the pre-merger EPS of B Limited and 200 is the post-merger EPS of A Limited, because the 1 is to 1 relationship is not there. It was 0.5 is to 1. So ideally what we need to do, only to the extent of 0.5 we need to take, right, to calculate the impact. Yeah, now I think it gets updated. Let me just quickly. Manish, can you again make my the other login as a host, please, so that I can share the screen? Perfect. Perfect. Thank you. Yeah. Yeah, we were here. Sorry. Yeah, yeah, yeah. Thank you. So what we were saying is that the EPS of B Limited and A Limited cannot be compared. So for that, we'll have to do adjusted for swap ratio, right? So 200 into 0.5, which will be 100 here. This will become the post-merger EPS minus pre-merger EPS of B Limited is actually 80. So there is a 20 rupees gain. Gain to shareholders of B Limited students becomes this much. Correct? So 200 minus 80, 120 would have been wrong. This is the right approach because 100 is the representation of the number of equity shares basis which the consideration has been discharged to B Limited. Clear? So coming back. So the effect of post-merger EPS on target company, please do adjust for the swap ratio as we discussed. And then compare it with the pre-merger EPS of B Limited, which is the previous one. Okay. And then finally arrive at the impact on the target company's shareholders impact. Clear? Sometimes the question will ask you that what is the value of the acquisition, and that too from different perspective. So let's say from the acquirer perspective, who is acquiring, from the A Limited's perspective, the value of acquisition is actually the value of the merged entity minus value of acquiring company before merger, right? So value of the merged entity will be arrived at how? Market price per share post merger multiplied by number of shares post merger, right? And this is the A Limited's value before merger. So A Limited's value after merger and A Limited's value before merger. Clear? So that will give you the value of acquisition. Yes. Now sometimes the question will ask you to calculate the gain or loss to the shareholders of both A Limited and B Limited. So if you see students, all this is basically the post merger. All this is basically the post merger analysis that we are doing, right? So yeah, in this case, what will happen if you have to calculate the gain or loss to the shareholders from A Limited's perspective? So the MPS of post-merger A Limited minus MPS of pre-merger A Limited. This is a very simple one-to-one correlation, right? Because here the ratio is 1-to-1 is itself. We're talking about A Limited earlier and A Limited now. Clear? For B Limited, again the same logic will apply, students. For B Limited, the market price per share of post-merger A Limited. Now this we will have to again adjust for the swap ratio minus market price of pre-merger B Limited. That will help us to arrive at the gain or loss. Sorry. I hope this is clear. So this is again the pre and the post comparison, pre of B Limited and post of A Limited, but that A Limited is adjusted for the swap ratio. Right? Because again, one share of A Limited does not represents one share of B Limited post merger until and unless the swap ratio is 1:1. If the swap ratio is not 1:1, in such a case, we will have to adjust the market price basis the swap ratio. Then the market capitalization. We all know the formula. What do we mean by market capitalization? Market price per share multiplied by the number of equity shares, right? This is basically the entire value of the company. Promoter holding. So we all know that for any company, there are promoters, right? Who are actually the ones who have got the company incorporated, who have got that business idea into the company, right? So the overall market cap out of that, whatever is held by the promoter, that is called as promoter holding, and the balance part is called as free float market capitalization, which is market cap into 1 minus x. Yeah. Now, the another two parts. Sometimes the question will ask you also to calculate the true cost of merger. So the true cost of merger is basically from the perspective of A Limited, that what is the real cost that has happened. So, okay, let me ask you a question. If there is a land of 1,000 crores, okay, this is the fair market value of land. If we purchase it in 1,200 crore, that means 200 crore is paid extra and B Limited is actually selling this land. A Limited is actually purchasing this land. It can very well happen. The answer is yes. Now, this 200 crore rupees extra that is has been paid as premium. So, this is basically the benefit to B Limited, and this is a cost to A Limited. Correct, students? It's a benefit and it's a cost. So, in a way, this is so one's benefit is actually the other's cost. This is the point what I'm trying to make here. So, this will lead to the concept of cost, true cost of merger, because from A Limited's, the true cost of merger is basically the gain to the shareholders of B Limited, which is the target company. That is the real cost that has been incurred. Then value of merger is actually gain to the shareholders of A Limited. If let's say there is some gain, now in this example, if let's say the 1,000 crore land is purchased at 900 crore, that means there is a gain of 100 crore to A Limited. They have purchased it cheaper, right? So that is the value of merger, students, right? So this is again from the A Limited's perspective, that what is the cost and what is the value. Clear? So the question will ask these parts. We will have to be careful while answering them. Okay. Now let's see. We have covered the questions then. Maximum exchange ratio. Yeah, these are the questions again. I'm just seeing if there is some important thing. Perfect. So now in this chapter, or let's say in any other topic, there is a good amount of cross referencing to the concepts. For example, here dividend growth model, right? So this this is basically the formula that is used to calculate the market price basis the dividends that are given. Okay. So it says that D1, which is the dividend to be paid after 1 year, divided by the KE, which is the cost of equity minus growth, which is the growth that you are expecting. So if you use this formula, you will be able to arrive at the market price per share, right? And this will be a dividend growth model. So sometimes the question will not give you the market price. It will ask you to calculate the market price using this. Okay, which can be used further. So questions, we will pick it up. The couple of questions that we discussed, yes. So if you see here also, as we were discussing that in any deal, in any merger and acquisition deal, there can be a minimum and there can be a maximum amount. So the minimum amount will be the lower range and the maximum amount will be the higher range. So the deal will get closed somewhere in between. Okay. So the minimum amount, if let's say is 100 crore, this is what the A limited will be starting point. This is the starting point of A limited. Maximum amount will be the starting point of B limited. Right? That what is the, sorry, what is the maximum that they are expecting, and somewhere they will agree in between. Now, if you see here again, we have explained the same thing. The value of the merger is basically the gain by the acquiring company in the merger process, which is A limited. Cost of the merger is basically the gain by the target company or its shareholder, which is B limited. Okay. So this question is actually asking you to calculate the book value as well, right? Book value per share. For that, if you see, they have given you the balance sheets as well. As I was saying that the book value per share can be used. So in that case, we will need the references to the balance sheet, students. Yeah, we'll have to go to the synergies now. Let's see. Is there some any other? So everywhere, I think the conceptually it remains same only. That what is the maximum consideration, what is the minimum consideration, what is the swap ratio, right? And what is the true cost of merger, what is the value of the merger. So majorly it is around those things, those lines. So this is the question on the NPA that we were discussing, students. In this, the weak bank's NPA is higher and the strong bank NPA is lower. And they are planning to take a 30% weight for calculating the swap ratio basis NPA. So they should not do 40 by 5. They should do 5 by 40, right? As the swap ratio. Perfect. Now let's come to the other parts, students. Okay. So let me do one thing quickly. Let me just take in from the study material. Just a second. Perfect. So first of all, we need to understand that what are the different rationale, or why do we really do the mergers and acquisitions. Just a second. My screen Yes. So, first of all, the rationale for mergers and acquisition, that why do we do the mergers and acquisition? The first and the biggest one is synergy. So, synergistic operating economies. Basically, this is called as synergistic operating economies. What do we mean by this? So, students, if you see that, let's say if there are two companies, okay, both of them are into, let's say, some kind of a business line which is closely related, okay. Let's say one company is manufacturing an automobile part, let's say brake, and the other company is manufacturing engine oil, okay. So there are two different companies, A and B. Now B is planning to get merged into A, right? So as of now, what would have been happening for these two different companies? There would be different sales team, right? Who would be doing sales for brakes in case of A Limited, and a separate sales team for B Limited, which is doing the sales of engine oil. Similarly, there will be different management, board of directors. There will be different compliance cost. Both of them are operating differently. There is a good amount of compliance cost. They will have to get their respective accounts audited. There would be different types of consultancies. There are different types of tax related matters, right? So all those things would be happening differently for both of them. They would be incurring cost. Then, as a customer, although if you see, they both will have a similar set of customers, right? So who will be their customers? Let's say the workshops where the cars are basically serviced, right? So the automobiles are serviced. So those workshops will be their customers, or let's say the dealers. Yes, Saminathan. Now, if you see, they have a common set of customers, but they are servicing through different channels. Okay. Now, what will happen if they merge? Let me also bring in one more fact here. Yeah. So A Limited and B Limited. Let's say this company is making a profit of 100 crore. This company is making a profit of 50 crore. Okay. So first of all, if we combine them, 150 should be there, which I also agree. Minimum profit they should earn collectively is 150, because individually they were doing this business. Now, after they have merged, don't you think it will eliminate all these factors for one company? Eliminate for one company. Now there is no need of two different sales team. The same sales team can even sell both the products because the customers are same. Only one management can actually oversee the entire process. The compliance will be only equal to one, which is only A Limited will have to do the compliances going ahead. So the B Limited's compliance cost will go down, right? So also in terms of approaching to the customers, now they will have a collective strength because now customers will also not need to connect to different people for the different products. They can just simply connect with A and place their respective orders for almost these two items. So don't you feel that there is a potential to even increase in the way the market is being approached, right? Yes, Saminathan, if both teams are there, then cost will be higher. Now, if let's say we are merging B into A, that means there will be a elimination. There will be a need to eliminate the duplication of the resources. And hence, you will not only get 150, but you will get something more. Let's say 50 crores more in terms of the saving of the cost. So this is called as synergy. So synergy is basically if you are consolidating two different businesses, it will help in increasing the overall profitability, not only to the extent of the standalone numbers, but even to the extent of the other things. So this is what we have mentioned here. So the new company's combined value of A and B is greater than value of A plus value of B. So 200 crore was greater than 100 crore plus 50 crore, students. Okay, clear? This is on synergy. And synergy will not only lead to the current profitability, but let's say in time to come, it can also lead to the potentially higher amount of numbers, right? That is where synergy is placed as a very important role in the rationale of mergers and acquisition. The second one is actually diversification. Now, what happens, students? All of you would have studied the systematic risk and unsystematic risk in the portfolio management, right? We are just linking it from over there. So, one systematic risk is a macro risk which will be there, right? Which cannot be eliminated. Only the unsystematic risk, which is very specific to that business, to that company, can be eliminated if you enter into different kind of ventures, right? Not only a single venture of a single industry. So this is called as diversification. Now diversification is basically to invest into different lines of the businesses, and the main objective here is to reduce the unsystematic risk. Now if let's say A Limited was carrying on FMCG business, B Limited gets merged into A Limited so that the real estate is also merged in with FMCG business, although it can operate under two different umbrellas in the same companies. but it's a diversification that we have done. Okay, so diversifying means that from your current line of business to invest into something else. Then the next part is around taxation, students. Now, what happens? There is a weak company. Weak company means it has accumulated losses. And there is a strong company. Strong company is one which is making good amount of profits. So the weak company which is having accumulated losses, from income tax point of view, these are loss which can be brought forward and these can be adjusted with the future profits. So these are some values assigned to it, right? In terms of the future tax adjustments, this will be set off against the future profits, right? Now, the objective of strong company to acquire weak company is such that the accumulated losses are transferred to the strong company, and strong company can actually utilize those unadjusted losses into its profit making amounts and hence pay a lower tax. Because in tax, subject to certain conditions, it allows you, in case of a merger, to carry forward the accumulated losses. Okay. Clear? Then the next rationale for a merger or acquisition is growth. Now, what happens if, let's say, there are two different companies, A Limited and B Limited? B Limited is having a revenue of 600 crores. So, what will happen here if, let's say, A Limited is acquiring B Limited, getting merged? Had there been no acquisition, so in year one, A Limited is earning 1000 crore. Not earning, but revenue is 1000 crore. In year two, let's say the revenue comes to 1100 crore. So there is a 100 crore organic growth. This is an increase. And this we call as organic growth because on the same base, you are getting a growth. This is there. Then for B Limited, if the acquisition happens, so the A Limited's revenue in year one of 1000 crore will move to 1700 crore because the B Limited's revenue is also getting added. So 100 crore organic growth is the delta and 600 crore inorganic growth is the increase. So if you see optically, this will look like 70% growth over the current business. Correct? So if let's say we have to, if let's say the management is of the view to pursue growth, right, as a element, because see, the growth is actually seen as a positive KPI once you decide about the valuation of that company. Correct? So higher the growth, better it is. So one time growth, if they want to bring in, they will just enter into a merger and acquisition, and then potentially they will keep on increasing their numbers on that growth base. Okay. Then sometimes what happens, the production capacities and in market shares are with different companies. Let's say there is an industry for which 60% of the market share is held by A Limited, 10% is held by B Limited, and balance 30% it is fragmented. It is with different individual people, right? Those are thousands of businesses. So only these two control 70%. Right now, what A Limited and B Limited decides is that B Limited will merge into A Limited. Now, collectively, they will have a 70% kind of a market share, students. Clear? So, this is basically combining the market power. That means market share, they are combining the same. Similarly, for production capacities also. Similarly, for production capacities as well. In production capacities, what happens? If let's say in a single, let's take an example of iron industry, for example, which manufactures iron as an output. Let's say 40%, 30%, and another 30%. Let's say 40 and 30 is held by A and B, and another 30 is held by different people. I'm talking about the overall production capacity, right? That how many metric ton of iron can be produced by these companies. Okay. So A and B will have good amount of power, right? Because they are controlling almost 40% of the supplies, and B is almost controlling 30% of the supplies. So if they want to consolidate the production capacities, they will do a merger. Now collectively, they will control around 70% of the supplies. Clear? So this is also one of the rationale for mergers and acquisitions. So students, if you see what all things we have covered till now for rationale of mergers and acquisitions, let's take a quickly revision. So one is synergy, right? Synergy is basically your extra amount of gain that is coming because of many factors, right? Then second is on account of diversification, wherein if you have to reduce the unsystematic risk, the companies tend to invest into non-related businesses. Third will be taxation, right? Taxation will be where we are seeking the benefits of tax to come in. Clear? The strong company will take over weak company. They will take the benefit of the unadjusted losses that are brought forward for the tax benefits. Growth, as we discussed, that growth is a very important parameter for justifying, or let's say for the market valuation. So hence growth becomes an important aspect. Okay. And growth can be achieved through acquisition. It will be an inorganic growth. Then lastly, about the consolidation of the production capacities and the market shares. Yes. Now let's come to the what are the different types and forms of mergers and acquisitions. Okay. Now these are from the perspective of whether they are into the same line of business, horizontal, vertical, all those things will come into the picture. Okay. So now let's discuss horizontal merger. First of all, by horizontal we mean this, right? So this means that there are two companies which are in the same industry. So industry means what? Industry means which is a collection of companies having common set of consumers with a common need. That is called as industry, right? Automobile industry, right? Let's say the people have a common need to have a automobile. Similarly, iron industry, similarly FMCG industry, right? They all are homogeneous industries in which the companies that are operating are serving and are competing against each other, right? Are serving for the same purpose. Okay. Yes, FMCG plus FMCG. You're right, Saminathan. So this is called as horizontal merger, in which two companies from the same industry gets merged into. The biggest one that I can recall is HUL and PNG. Sorry, HUL and GSK, GlaxoSmithKline, right? So the Boost and Horlicks, those brands were merged with the business of HUL, right? So this was of the same industry. They both are FMCG. Vertical merger. Yes, bank plus bank. Very good, Samyanathan. If two banks are getting merged, those are horizontal merger. Vertical mergers. So vertical, if you see, is something like this. Now this represents a customer and a vendor. So let's say A Limited is there. In the value chain, if you see, it provides the output to the customer and it takes a input from the vendor. So if let's say there is an opportunity to merge vendor with A Limited or customer with A Limited, this is called as a vertical merger. If customer gets integrated into A Limited, this is called as forward integration. If vendor gets merged into A Limited, this is called as backward integration. And there is a buyer seller relationship. That is why in this M&A, this is called as a vertical merger. Yeah, sorry. The next one is actually conglomerate merger. Now you would have known this term conglomerate earlier, which means that there are many diversified businesses. That is called as conglomerate merger, right? A Limited and B Limited, both of them are unrelated, and they are actually getting into a merger. That is called as a conglomerate merger. So horizontal, they are actually related as a competitor. They are into the same line of business. Vertical, they are again the customer or vendor of each other. Conglomerate, there is no relationship. They are not into the same line of business. Co-generic merger. Now, this is an important one to understand. Co-generic merger means where their genre is similar, right? That is called as co-generic merger. Now, here, if you see, there are two companies, A Limited and B Limited. Either they are into the same industry or there is a some factor that is common. For example, some common technology they are using. They have a common distribution channel. They have a common product line. Let's see how. Let's take this to an example. Let's say A Limited is a NBFC which is into the process of giving automobile loans. Okay, loans for acquiring automobiles. B Limited is also an NBFC which is into credit card or personal financing. They have been issuing credit card or personal form of financing. If you see, their products are different, but product line is same, right? So the product line is giving credit, but the products are different. However, they have a different consumer set, right? Because the one who would be asking for auto loan will be a different person from the one who is asking for a credit card. They are into the same industry of giving loans as NBFC. So this is a wider industry, I would say. Okay. And the channel through which they access customer agents is through agents, right? They are giving everything through agents. And then there is a product line, right? Common product line. So if both of them merges, then this is called as a co-generic merger. If you see, this is not a pure play horizontal merger. This is not a pure play horizontal merger, right? So hence we are terming this as co-generic merger in which the generation is similar. Then students, reverse merger. This is an important one. This we will cover in detail what is meant by reverse merger. Okay. Then acquisition is basically purchasing the majority stake or controlling the board of directors, where we are purchasing the majority stake or the control is with us. That is where we called it as an acquisition. Okay. Now comes the concept on reverse merger, students. So generally, students, we have seen that a larger company is actually acquiring a smaller company, right? And smaller company gets merged into larger company. Yes, Saminathan, it is one and the same thing, right? And this is what we are discussing. Yes, Ind AS 103 actually talks about the accounting treatment of the business combinations, right? So it says that how will you account the assets and liabilities in A Limited if, let's say, B Limited gets merged into A Limited or A Limited is acquiring some part of business of B Limited. Okay. Now, this is the general trend that bigger company will acquire a smaller company and smaller company will get merged into the larger company. Now, private company and public company, there are two different companies. Private company is a small company and public company was a large company, right? Because public company is listed at a stock exchange. Now, here, if you see, this public company is having accumulated losses and there is no operating basis, right? So, what will happen here? The private company will acquire public company, public company will merge into private company, but the effect of this will be that the private company will go as public. Here, the small company, which is the private company, is acquiring a big company, which is a public company. Why public company is getting sold? Because they are under losses, right? So they need money to revive themselves. Hence, they are getting merged. So in this, what has happened? Private company has gone public without the need of any IPO, without the need of any documentation and any other compliance cost. Okay. Then there is another series of sell off, or let's say the process of disposing of a business in the form of divestiture. So divestiture takes different forms, students. One, selling of assets. Second, grouping of assets. Third, or any other business units, right? So this is happening with the objective that the management don't want to continue into that business. They just want to pay attention to the core business students, right? So selling assets or group of assets are there. Now it can take different forms. One, sell off or partial sell off, right? In this case, what we are doing is we are just selling off some part of the business through the form of a slump sale. Okay, this is happening through the form of a slump sale. Then second is spin off, right? The second one is spin off. In this case, let's say A Limited is having two business 1 and business 2. Business 2 is actually getting transferred to B Limited. It's a new company, and the shares of B Limited are assigned to the shareholders of A Limited. Okay, so this is actually called as spin off. You are spinning off your business and creating a new legal entity in which that business will be carried ahead. Clear? Perfect. Then the next is actually split up. Now, split up, what happens? The different businesses are getting split up. That means the original company is getting dissolved, and then different companies are getting incorporated for the different businesses. So the original company is getting splitted up into different other companies. That is called a split up. So the difference between spin off and split up is, in spin off, the original company is also remaining. Only a part of the business is getting transferred to the new company. Here, the original company is getting dissolved and the new companies are getting formed. This is called as split up. Okay. Equity carve outs. Equity carve outs means that one, we are doing a spin off. Spin off happens how? By creating a new entity. Apart from that, we are also issuing new equity shares in the market. Clear? So if it is happening, that means we are issuing equity as well as we are doing a carve out. So this is called as a equity carve out. Okay, then comes the demerger or the division of the family managed businesses, right? So in case of, let's say, there is a division happening or there is a demerger happening, right? In the family managed businesses into different companies, that is called as the, that is also one of the divestiture. But here the prime objective is for the families managed businesses, the division happening. Yeah. Yeah, common control is, it will still be regarded as a common control business transaction. Appendix C to Ind AS 103. Okay. It talks about the common control business transactions. Okay, so the common control is where The control is done by the same person before and after the merger. So in spin-off, in so it can happen in different forms. So if let's say it is for the one of the corporate groups, right? One of the corporate groups, it is there, and the split up is happening between that corporate group itself, then there will be a common control, students. Okay. Then comes the next part of financial restructuring. So, students, if you see, financial restructuring is a term which is used to save or to reconstruct a financially sick company. What do we mean by a sick company? A sick company is the one where the losses are higher, right? They are even higher than the share capital. That means there is a negative net worth that is sitting in the balance sheet of a company. There are no debts. I mean, there are no amounts that can be repaid in the form of a debt. There is no cash flow that is there. The business possibility or the reality is very bleak for the company. So, financially, the company is sick, right? It is it is an insolvent one. Now, how can we revive such companies? Right? How can we revive such companies through some of the restructuring methods? One, we can issue equity shares, right, that are already issued. In that, we can reduce their paid up share capital. We can say that earlier it was 10 rupees paid up, but since we have made up a loss, so we are reducing the paid up share capital to 5 rupees so that you are eligible, or let's say your contribution of 10 rupees is written off by 5 rupees and only 5 rupees are remaining now. That is equity shares. Second, on loan or borrowing. So sometimes what happens, the financial institutions who have given the loan to that sick company, they will come and they will also try to basically do the financial restructuring bit, because their money is also at stake. So they will also feel that whatever is we are getting, let's see what is the best deal that we can get out of it. So out of that 10%, let's say they have agreed for a 10% interest rate, they will be settling it for less, let's say at 9% of interest rate. So 1% that they have gone foregone. Loans, which are actually convertible into equity shares or debentures, which are convertible, they also will be taken up for the conversion, students, right? And hence, to avoid any cash outflow, they will be converted. Working capital. So, in case of a working capital benefit, the vendors will be approached so that the amounts can be foregone and it can be written off. Clear? So let's say the vendors will agree, okay, 25% of our outstanding can be redeemed, balance 75% can be paid, because the situation is clear with such companies. Okay. So any doubts, any questions till now, students, in mergers and acquisitions, please do let me know. Okay. Perfect. So just a second. Let me just see if there are any queries on the query handle. No. Perfect. So students, let's do a quick break now. Okay. Yeah, sorry, there is one question before that we will take. Saminathan is asking loan borrowing debenture. We studied in financial instrument in India. Yes, it's part of India's 109. 109. Yeah. Okay. So let's take a quick break of 10 minutes. Let's again reconvene back. So, welcome back, students. um, yes, on the financial restructuring we discussed. Now, let's come to another topic of ownership restructuring. Ownership restructuring means when in the ownership some changes are required or warranted to make sure that some of the let's say some of the changes are happening. For example, one, going private. Now if you see, a public company can go into a private company by buying back its own share from the market. And the reason for going from public to private is that, let's say, they would have changed their model in which they would want to operate. Right? So this will mean that now no more public at large will be involved as their owners, as their shareholders. Now the shares will be closely held by some of the few companies, right? Few individuals, right? So this is one of the ownership restructuring, that means going private. Second one is around the management buyout, students. Management buyout means that the management itself of the company will purchase the company, right? So currently, if you see two things, ownership is different from management. Ownership is different from management, right? So management itself of the company will purchase the company. Leverage buyout. Leverage buyout means that the purchase consideration is discharged by borrowing the amount from the backend. So, leverage means what? Leverage means that you are leveraging on borrowed funds, right? Let's say you are borrowing it at 8%, but you are investing it at 15%. So, this 7% delta that you are earning is called as the leverage buyout, right? Is called as the leverage buyout. Okay. So these are called as MBOs in short form. These are called as LBOs, leverage buyout. Okay. Then equity buyback. Equity buyback is basically you are buying back equity from the market. Why does this happens? Because you will want to, let's say you are sitting on a cash reserves, cash in your balance sheet. You don't want to distribute it as a dividend, but you want to reduce your liability, right? In the form of equity that is sitting. So what you will do, you will call for the share capital back and you will pay the amount to those shareholders, right? And you will buy back your own equity, the company, and you will cancel that amount that you have bought back from the shareholders. So if you see, these all transactions are somewhere related to the ownership, where we are going private, somewhere we the management is taking over, right? Let's say the management will pay the amount and they will take over the ownership, right? Somewhere there is a leverage buyout that is happening, wherein the amount is taken on a borrowing basis and the purchase consideration is being paid. Then equity buyback. Then let's come to the special purpose acquisition companies, SPAC. The special purpose acquisition companies are the ones where these are listed companies, okay? And in the IPO itself, so students, if you know IPO, we will have to specify that what will be the use or what will be the objective of this IPO. The use of the funds that we are going to do is going to invest into the business, right? Or we are going to use it to sell the shares of the previous shareholders, right? Who is the selling shareholder? So all those things. So IPO, an initial public offer, is basically used to raise funds from public at large that we know. So what will happen? SPAC will launch an IPO. Yes, Saminathan, there are different reporting requirements in Caro as well. So in SPAC will launch an IPO, right? And simultaneously, they will also create a trust. Okay, they will create a trust. Now, that trust will be responsible with some amounts that are given, right? They will foresee, they will govern the holdings of some of the amounts, or somewhat in escrow accounts. They will keep the monies. Sorry. So SPAC is what they will do. They will create either a trust or they will create an escrow account in which they will park all the monies that are received from this IPO for 2 to 3 years. Okay, so they will say that in the IPO itself, they will mention that for 2 to 3 years, we will keep the money collected in some account or the trust, and we will be in the process of acquiring a target company. We will find out a target company in this 2 to 3 years, and we will then acquire it using these funds. Before finalizing the deal, we will again take a in principle approval from all of you after 2 to 3 years once the deal is about to finalize. So, special purpose acquisition company means that they are formed with the perfect. So I will recap what I was discussing, students, for your benefit. I'm sorry for the network issue. So we were discussing about the special purpose acquisition company. Special purpose acquisition company, we discussed that is a company which will raise amounts through IPO. They will launch an IPO, and after launching an IPO, they will collect the proceeds and keep it for 2 to 3 years in the form of a trust or in the form of an escrow account. Reason being, they have not finalized the use of such proceeds, that where they are going to use it. Within this 2 to 3 years, they will specify or they will find out which companies they are going to invest in. Okay. And after they have finalized the deal, I mean, before they are finalized the deal, approval from majority shareholders will be required. After 2 to 3 years, we are talking about. Till the time deal is finalized, the money is kept in escrow account or a trust. And they will also do a very proper due diligence, right? Because the shareholders will be asking for it. Once the due diligence is done, then they will be giving the approval. So these SPAC companies are also called as blank check companies, where let's say from a shareholder point of view, you are writing a check, but you don't know that what is the use of that funds. So hence it is called as a blank check companies. Simple. Clear, students? Now let's come to the questions, to the couple of case studies that we have put in. Yes. The case scenario one, students. This is on mergers and acquisitions. AES wants to acquire DNF Limited and has offered a swap ratio of 1 is to 2, which is zero point 0.5 shares for every one share of DNF Limited. So that means they have already defined the swap ratio. This is already defined. Following information is provided for both acquiring company and the target company, right? So the first one is profit after tax, equity shares outstanding in numbers. Please do note here, these are the number of the equity shares. They have given us PE ratio, students. If you see, P ratio can be used in case we have earnings, we can calculate price. In case we have price, we can calculate earnings. We have price here 30 and 14. From the information given above, choose the correct answer to the following questions. The number of equity shares to be issued by AES Limited for the acquisition of DNF Limited would be. So first of all, they're asking us that how many number of shares to be issued. We have swap ratio of 0.5. Total number of shares is 360. Let's put it here. Is 0.5 is to 1. Right? So current shares numbers of the name of the company is DNF Limited. 360,000 shares. Hmm. Hence, number of shares to be issued will be 3,60,000 multiplied by 0.5, which is actually 1,80,000, right? So the correct answer here is B, which is 1,80,000 students. The EPS of AES Limited after the acquisition would be. Now they're asking about the EPS after acquisition, what it will be. So for that, first of all, we need to know what is the profits after tax that is given to us. Now this is a question in which we are issuing the shares, right? So then we need to take the first case, right? In the post-merger EPS calculation, you remember share settlement, cash settlement, and then I discussed a third case also of a mixed settlement. So this is a case of a share settlement. So in this case, let's calculate the EPS. EPS post-merger of AES Limited will be PAT of AES plus PAT of DNF divided by number of shares already that are issued for AES plus number of shares to be issued. So this is how much? 36 lakh and 7 lakh 20,000 divided by number of shares that are issued are how much? 12 lakh plus 3 lakh 60,000. So this comes to yes, very good, Samyanathan. You're right. The answer that you've given is correct, and the formula also is correct. So this is coming out to be 3.13, which is C part. So the right answer here is C part. Perfect. Then the third part, the equivalent earnings per share of DNF Limited would be. Now see, they're asking about equivalent earnings. That means what proportion of one share of the acquiring company, which is AES Limited, will represent DNF Limited. This is what they're asking. This will be calculated how? This will be just simply calculated as multiplying the post-merger EPS with the swap ratio. Equivalent earnings per share of DNF Limited. Post-merger EPS was 3.13 adjusted for swap ratio 0.5 is to 1. So equivalent earnings per share 3.13 into 0.5 is to 1. So this becomes 1.57. So the half of it. So 1.57 is their post merger EPS. Now, as an extended part, if I may ask you, what is the pre merger EPS of DNF Limited? That is 7,20,000, 3,60,000, right? So this is actually 2. This is not asked in the question, but I'm just trying to, yeah, solve it so that we can compare it. So if you see, before merger, the shareholders were getting an EPS of 2 rupees of DNF Limited. Now, post merger, their equivalent earnings per share has come down to 1.57. Correct? So that means there is a loss of 0.33, 0.43, sorry, per share that has happening. Okay. So the impact is there is a loss to the shareholders of DNF Limited. The swap ratio is not beneficial to them. If AES Limited PE multiple remains unchanged, then its expected market price per share after the acquisition would be. Now the question is saying that the AES Limited's P multiple. Now, if you see the P multiple of 10 times is actually pre-acquisition. Generally, what happens practically in the market, once an acquisition happens or a merger happens, there is an impact to the P ratio that comes. If let's say the potential growth prospects are good for the business, the P ratio might increase. If the potential growth impacts are not there, let's say the business itself is going through a rough patch, that means the P ratio can go down as well because you have purchased, you have added a business which can have a lower multiple, right? So in this case, they are saying that assume it to be the same. P ratio is 10 times, assuming post merger P ratio to be 10 times. Then what is the overall value? I'm sorry, third, we have not given the correct answer, 1.57. So C is the right answers for the third. Then for the fourth, then simply we'll have to do 3.13. So the price is equal to PE ratio multiplied by, yes, very good, Saminathan. EPS, so 10 times multiplied by 3.13, which is equal to 31.3. So the total price becomes 31.3 rupees per share. This is the market price, which is actually this much. So the right answer is C for the fourth part. Perfect. Thanks a lot, Saminathan. Your answers are correct. Let me just see if there are any other queries. Sorry. Perfect. So let's go to case scenario 2. The company X Limited proposes to take over Y Limited. The chief executive of the company thinks that shareholders always look for the earnings per share. Therefore, he considers maximization of the earnings per share as his company's objective. The following information is available in respect of X Limited and Y Limited. Net profit is given as 80 lakhs and 15.75 lakhs. P ratio is 10.5 and 10. Current market price is 42 and 85 for both X and Y Limited. From the information given above, choose the correct answer to the following questions. If the company borrows funds at the rate of 15% rate of interest and buys out target company by paying in cash. So students, please note this is a question on paying in cash. How much it should offer to maintain its EPS assuming a tax rate of 30%. So that means they are saying that the EPS pre and post should be same. You find out a consideration that needs to be paid in form of the cash, and remember cash is borrowed at 15%. So simple, we'll just take the post and the pre EPS as equal, and for calculating the post EPS we'll assume it to be the X. Okay. Let's see. So first of all, students, the amount that is available for the interest payment would be, so if you see, 80 lakhs is the net profit after tax. So let's say X Limited and Y Limited net profits 80 and 15.75. Tax at the rate of 30%, right? Yes. So the profit before tax is how much? We just divide 80 divided by zero point 0.7 and 15.75 divided by zero point 0.7. So this comes as 136.79 lakhs, and this comes as 114. No, sorry. Wait. This is actually 114. 114.29 lakhs. This is the gross amount, and this one will be 22.5, right? This is the amount that will be there, profit before tax. The cash that can be offered will be. Now, students, if you see 22.5 is basically the profit before tax amount. So this amount will get added to the profits. Okay. The if let's say X Limited and Y Limited decides to go ahead with the deal, so this 22.5 lakhs constantly will get added to the to the profits of the combined business operations, right? Now, the moment it happens, that means there is an addition of 22.5. That means the maximum amount of interest year on year that can be paid is also equivalent to the 22.5 lakhs, right? So, the cash that can be offered is actually 22.50 lakhs, which is the maximum amount. And this is as good as, wait, let me say this. Amount of profit before tax that will be added to X Limited's consolidated profits is this much. This is the maximum amount. So the cash that can be offered to purchase Y Limited will be lakhs divided by 15%, right? Because this is the interest component of 15%. So this is the maximum amount that can be paid, which is 150 lakhs. So if you give a loan of 150 lakh, if you take a loan of 150 lakhs, on that you'll end up paying 22.5 lakhs as the interest, which is as good as the PAT that is getting added and interest that is getting reduced. So the situation will remain same. Clear? Yes, 150 lakhs, Saminathan. The answer is correct. So, maximum amount that you can pay to acquire this is 150 lakhs, which is the C part. Clear? Because if you pay 150 lakhs, on that you will pay interest also as 22.5. The amount of PAT that will get added here is also 22.5, right? So, in totality, you are getting it as 0. So this is the maximum thing you can offer. In case they're asking a more consideration of more than 150 lakhs, then you should not offer it, because then it will be a cost impact to X Limited, right? This will end up a cost impact to X Limited. Maximum exchange ratio. Now they are talking about the exchange ratio here, which the company should offer so that the company could keep EPS at current level. Now they are saying that let's evaluate it on an exchange ratio basis. Maximum exchange ratio to keep EPS at current levels. So let's calculate the exchange ratio basis EPS, right? Clear, students? So EPS, using EPS, if we calculate the exchange ratio, that will help us to contain the EPS being at current levels. Okay. So X limited, Y limited, earnings were how much? Now there are two ways. We can use the P ratio and the current market price per share as well. So 42 divided by 10.5. The PE ratio is 10.5 and 10. Market price is actually 42 and 85. Okay. And hence the EPS will be market price divided by the PE ratio. So 42 divided by 10.5 and 85 divided by 10. So here it is 4 and here it is 8.5. This is their EPS. Yes, very good, Saminathan. So the exchange ratio here will be EPS of Y limited divided by EPS of X limited. Correct? This is how we are going to do. EPS of Y limited divided by EPS of X limited. So this is given as exchange ratio will be 8.5 divided by 4, which is actually 2.125 is to 1. Yes, very good, Saminathan. Your answer is correct. So this is the exchange ratio at which EPS is not impacted. 2.125 is to 1. Clear? Now let's take the correct choice from here. This one. B is the right answer. Number of shares to be issued by X Limited shall be approximately. Now we'll have to calculate the number of shares. First, we'll have to calculate the number of shares of Y Limited. So, students, if you see, we have total profits and we have earnings per share. So, EPS multiplied by number of shares is equal to total profits, right? So, EPS into number of shares is equal to total profit. And if we calculate number of shares, then it will be total profit divided by EPS, which is 15.75 lakhs divided by 8.50. Sorry. So how many number of shares Y Limited have currently? 1.8529 lakh shares. So the number of shares of Y Limited is 1.8529 lakhs, and number of shares to be issued. In this, we will multiply the exchange ratio, right? By X Limited is actually 1.8529 lakh shares multiplied by 2.125 times. So this actually gives us 3.9375 lakh shares. So this will result into this much of shares to be issued. And the right option here is option number A. Third A, Sabminathan. Second is B. Yes, third A. Perfect. Thanks a lot, Sabminathan, for answering. Your answers are correct. So with this, the topic of mergers and acquisition comes to an end in terms of the revision. Please do let me know in case we have any queries. Let me check the query handle as well before we move to the second topic of today. Wait, tradition. Yes. So let's move to startup finance, students. So startup finance, students, is actually a topic which deals with the definition of a startup, the concepts of startup, what are the different ways and modes of financing the startup, right? Because a startup being a new company or being new entity, the conventional forms of financing it is not very much available, right? So hence all those things are discussed here, right? So startup finance, first of all, let's understand what is meant by a startup. So startup as a definition is actually defined by one of the notifications issued by the government of India. Okay, they have defined the limits basis which a business can be qualified as a startup finance. What are those limits? Just a second. Yeah. So government of India have actually given a notification. As per that notification, first of all, you should be a private limited company, right? Or a registered partnership firm or a limited liability partnership firm in India, right? We all know that this is governed by LLP Act, Limited Liability Partnership Act. Private company is governed by Companies Act, right? And registered partnership firm is governed by Partnership Act, right? So there should be some form of a legal entity which is registered, regulated. That is point number one. Second point, okay, who all cannot be there then? Public company and sole proprietorship cannot be part of the startup. Okay. Then, second is they should be in the first 10 years of incorporation. It should not have happened that the business is running for more than 10 years and still they are being called as startups. Why? Because now they are matured organizations, right? They are more matured organizations after more than 10 years. That's why. So only first 10 years of incorporation will be given. Then next, the turnover should be up to 100 crores. That is what they define. That if the turnover is very high, then also it is not regarded as a startup. So in case in the eighth year the turnover exceeds 100 crore, then from eighth year onwards it is not regarded as startup. So turnover should be 100 crore. First 10 years of incorporation should be there. Then the last one, it should not be formed up in by using a split up or a reconstruction of a existing business. Business was already existing, but now you have created a new company, you have transferred that business to a new company. All those things are not allowed. It has to be a new business from scratch, and it has to have these features very much there. For example, innovation, development, deployment, commercialization of a new product or a service which is driven by technology or intellectual property, right? So it has to demonstrate all these things. So there has to be a use of technology, there has to be a use of intellectual property, right? For example, some of the online platforms, right? It is not just simple plain selling of goods, right? Because there is no new idea, there is no new product. So it has to have a new product, services, or a process, right? Let's say you are doing a similar thing. Let's say you are producing a similar product, but you have a very different and innovative process by which you are producing it. So that only will qualify as a startup, right? If there is no new innovation, development, deployment, then it's not a startup. Okay. So it should, the entity is working towards innovation, development, or improvement of products or processes or services, or if it is a scalable business model with a high potential of employment generation or wealth creation. Clear? So these all things are a prerequisite for being a startup, right? Now, once they are startup, as per this notification, then they will enjoy some of the benefits, some of the subsidies in different schemes and in the income tax related stuff. Yes, unicorn means that only. Unicorn means where the valuation is crossed 1 billion. Okay, clear. Now let's come to the topic of innovative ways to finance a startup. Now there are different. Now personal financing means that where enter. So innovative ways to finance a startup means those ways which, I mean, if the question asks you what are the innovative ways to finance a startup, we need to come up with this list, right? And in this, what we are discussing first is the personal financing. So the personal financing means where entrepreneurs themselves give the financing to the startup using the personal available pool of funds, personal available sources. For example, their personal money that they are going to put in into the company, right? Second is personal credit line. So these are basically the credit cards and all which they use for their personal purposes. They are being used as a innovative ways to finance a startup. However, the banks are very cautious while they grant a personal credit line, right? They will only grant it if it is proved that the business have sufficient cash repayment capability. Then the next part is actually family and friends. So family and friends are for those wherein, let's say, the sources of finance is available within the family or the friends, right? So in this case, what will happen? The family and friends are the people who generally believe in you without even thinking that your idea will work or not. They will still be able to invest behind your ideas. These are not equivalent to the loan obligations which a bank will give to you, right? Because the bank will have strict terms and conditions. They will ask for a number of things, right? So these are another innovative form of getting the finance, which is from the family and friends. Then the next one is around peer-to-peer lending. Let's say there are two different founders of a startup, one who is engaged in one of the business, second in the other. Now both of them are peers to each other, right? Because both of them are into the startup. So if, let's say, one is having a surplus for some time, they will lend it to the other peer who will need it, right? So that they are actually able to help out each other. And in case the other one will need in future the amount, the other person will also be able to lend. So many small and ethnic business groups have similar faith or interest, generally support each other in their startup endeavors, right? So you would have also seen, so whosoever are the peers in their business, so they will support each other with the short term lending, and then they will repay the amount back later on. Next one is crowdfunding. This is actually a very good concept. In this, what happens? Crowdfunding means that you present an idea on a portal of your startup, and then there are many small investors who are registered on that portal as investors. So they will go through your startup idea and they will kind of invest very small amounts as well into your business idea. So crowdfunding is the way in which smaller ideas, so smaller investments are also pushed. So the crowdfunding means that lot of people are investing small amounts in your idea. That is called as crowdfunding, right? But here you'll have to advertise your idea, right, onto a platform. Yes, crowdfunding means small amount collected by way of social media to goes to the big amount. Yes, Saminathan, you are correct. Family and friends by way of a promissory note. Yes. So what happens? Your loan that you are giving. So in terms of the documentation, you will sign a promissory note that you will promise to repay back the amount as well as the interest, right? So crowdfunding itself is also a startup idea. Correct, because where you are, there are different platforms who are themselves a startup. They are actually helping the others to raise their funding through the help of crowdfunding. And then, while let's say you want to exit the investment, then also there are some criterias in the crowdfunding using which you can actually exit from that investment. Then there are micro loans. So micro loans are small loans that are given by the individuals at a lower interest rates to the new business ventures. So these loans can be issued by a single individual or aggregated across a number of individuals who each contribute a portion of the total amount. These are called as micro loans. So these are micro loans, micro form of giving the financing. Then the next one is vendor financing. This one is very easy and very simple. This one is very quick to do. For example, your vendor has agreed with you for a pay term of 10 days after they have provided the goods or they have given the services. Now you don't have money to pay or you want to get into the financing of the startup. So what you will do, you will request your vendor that can you not give me a 90 days of a credit period. So balance 80 days of the credit period, I will enjoy as a finance. So this is also one of the innovative ways. So where vendor is actually financing you. Hello? Hello? Yeah. I hope it is audible now.
Yes, sir.
Okay, sure. Thank you. Sorry, there is some issue. I think, yeah. So what I was saying, sorry, we were on the purchase order financing. I will repeat the part. On the purchase order financing, let's say we have got a valid purchase order and that valid purchase order is a very big purchase order, okay, that cannot be supplied with the available working capital that a startup have. So what it will do, it will go to a financing company, show that purchase order and obtain finance using that purchase order, right? So this is called as purchase order financing, wherein you are getting a finance using this PO,
Sir, here I
right?
have one doubt. What is a purchase? A purchase order means the customer will give the order to the supplier. Is that you are talking
Yes,
about? Okay.
supplier end. We
Okay.
are talking about supplier end.
Okay.
Supplier end is a
From
startup.
yeah, from customer to supplier, they are giving the purchase order. So that
Correct.
here the startup company will give the sales order to them.
Y- Yes, yes, yes. Here the startup company will be having a sales order against that purchase order. Yes.
Okay, okay. Because of that purchase order given by the customer, the supplier does not have the sufficient fund, so that they will give the advance to us, startup company. Is that way?
No, no, not they will not give. So they will give a purchase order only, but the startup will take this purchase order to a third party, which is
Oh,
let's say a
okay.
financing company. And that financing company will actually issue the funds against this purchase order,
Like factoring.
like factoring. But
Okay.
factoring happens for the receivables. Once
Yeah,
the
yeah.
receivable is booked, that is the next part. So we don't call it as factoring, we call it as a purchase order financing because this is
Oh,
before booking the receivable.
okay, okay. So factoring will come after the sale.
Factoring will come after the sale, yes. After you have recorded the receivable.
Right, sir. Actually, I slight confusion on the point number 8. Okay, now it is got
Okay,
clarified, sir.
perfect. So in case you want me to put it here, let me just say. So let's say A and B, there are two different parties. A is the startup and B is the customer, and A is actually the supplier also. Okay. So this is a supplier startup. So let's say today they will issue a order. So B will give to A an order today of let's say 1 lakh rupees. So this A will go and get a finance of it, right? Against this, they will get a 1 lakh rupees. Let's say using this finance, they will fulfill the order. After fulfilling the order, they will book the receivable with them. Now, let's say A here wants more money, so they can go and do the factoring of this receivable as well, which is the next point we are discussing here. The factoring of account receivable is basically you are again approaching a bank or a financing company and you are saying that this much is receivable, you can give me money now, this much is receivable after let's say 60 days, so you can receive that amount but you give that money to me now because I am in need of funds. And again it is in two forms, one is on a recourse basis and second one is on a non recourse basis. So the one on a recourse basis means that the risk is not transferred, right? So let's say tomorrow the customer is not paying to the bank or the financing company. They have a right, they can come to us and claim back the amount. They can come to the startup and claim back the amount. That is recourse. Non recourse means that the risk is getting transferred. They cannot claim the money from us. For example, if the customer is not paying to the bank or the third party financer after 60 days, then they don't have any right to collect it from us. Yes, recourse and non recourse we have studied in securitization also, and the concept remains very much similar. Okay, so what the companies will do in factoring accounts receivable, they will discount the receivable. So let's say after 60 days, you have to receive 1 lakh rupees. So they will say today the value is only 98,000 rupees. So I will pay you 98,000 today, and 2,000 will be my interest income. Okay, so the startup will get 98,000 as the finance. This we have already discussed what is meant by unicorn. Unicorn as a concept means where your valuation have reached 1 billion USD, right? So this is called as unicorn. I mean, this is just a tag that is given if you reach this kind of a valuation. Now the next part is the modes of financing for startup. Now if the question asks you that what are the modes of financing, then we will have to write these points. These are not innovative ways. Innovative ways were what we discussed, right? Now in terms of modes of financing the startup, the first one is bootstrapping. Bootstrapping means that to find out internal ways. So the literal meaning of this is find out internal ways to fund, which are, let's say, trade credit. Okay, trade credit means that we go to a vendor and ask for credit, that let's say the payment term to be 90 days. Second, factoring. Factoring means again that we have discussed above, right? Your AR balances are there. You just go and take money equivalent to that at the present value. Leasing. Leasing is basically rather than purchasing your assets, you can take them on lease and pay the rent. Because see, initially with the startups, there is no big amount of capital that is available that they can invest in the assets, right? For example, laptops, for example, computer equipment, for example, the plant and machinery, for example, vehicles. So all yeah, sure. So I'll just repeat. I just checked the internet. I think today internet is coming and going. The speed is although looking fine. No worries. Sorry for that. So what I was saying is on leases. Leases is basically you are not purchasing the asset right away, but you are actually taking it on rent. So it is also one way to fund your current capital requirement, right? Then on angel investors, the second way of modes of financing for startup is angel investors. So angel investors are those who are high net worth individuals who like the idea of that startup, who would want to invest into that startup. So those individuals are called as angel investors. Yes, by availing these, we can avoid huge investments. You're right, Saminathan. Then there is next form which is called as a venture capital. So venture capitalists are those who come with a objective of investing, increasing that value of the investment by their intervention in the day-to-day operations, and then finally exiting that investment at a premium, right? So they come with a specific objective. So the way this chart is there, so there is a private equity firm. Venture capitalists are operating through these private equity firms. They will float a SPV, which is a special purpose vehicle, and there will be general partners who are decision makers in this SPV who will be appointed by the private equity firm. They will create a pool of funds by investment. So they will also put some of the investment, and they will invite investments from the banks, financial institutions, pension funds, and all of them. These are called as limited partners because their liability is limited. Okay, they will invest into these pool of funds, and then this pool of funds will invest into different startups. Okay, so this entire process is called as venture capital process. The firm here is called as the venture capitalists. The people here are called as the limited partners who are investing. So generally what happens, the private equity firm will also invest, let's say 20%, and balance 80% of the investment will come from here. There is a manager and administrative and advisor also who will be appointed here, whose role and responsibility will be to assess the startups related performance, that which startup you need to invest. So this is the model on venture capital, right? So they come with the objective of buying, growing, and then selling. So they will invest now. So they will intervene such that the investment grows 7 times in 5 years, and then they will disinvest and they will make profit, and then they will go, right? There are different structures to the VCs. One, there is a offshore structure, there is a unified structure. In offshore structure, the SPV is outside India, but the manager and the investment sits in India. That means the startup is the Indian, but the SPV that is created is outside India. That is, we call it as offshore. Offshore means this is not part of India. This is offshore. That is, the investment is coming from outside. Unified structure means that the SPV is outside, but the investors who are investing in this pool of funds are actually from India, and the investment is also happening in India. Only the SPV is outside India. That is called as the unified structure, students. And this is just a correlation between a private equity and a public equity. Public equity happens through IPO, and private equity, which means that is privately placed, that is called as a private equity. Okay. Then this is a topic on succession planning in business. So what happens, students, in any of the business, whether it is a startup, whether it is a non-startup, the importance of success planning is huge. Why? Because if you are not able to do a succession planning of the critical roles, there is a risk of the business being continued. Okay. So why it is important? First of all, there is a risk mitigation. It can help to mitigate the risk of, let's say, if today um, the CEO or the major positions of the companies are not having any successors and they fall due, then who will run the company? Who will take those decisions? So, from a risk mitigation point of view, this is important. Second is cause removal. Cause removal means that if there are some non compliances in terms of the Companies Act that board of directors have done, or let's say that CEO have done, and they are removed because of some of the some of them, right? So then who will be taking over? So this is important from that angle. Then it also helps to build in the talent pipeline, right? Because the people who are below these leaders, they will also see themselves sometime to do the to execute those functions, right? It will also help in resolve the conflict resolution, because if the succession planning is properly planned, then the different people who are running the race for reaching to that position, that conflict will also be neutralized, right? And this is the last part, is again aligning. Then on the business succession strategy, how we can really execute the business succession, there are different steps to it. The step one is first of all to evaluate that which all positions you need the business succession. Let's say you have 2000 employees working in your company. Do you need succession for all of them? The answer is no. Maybe you will need to identify those critical positions which need business succession. Second step is the mapping of the competencies of the above position, that what is the requirement of those positions, what are the different skill sets required. Step 3 will be identifying competencies of the workforce. So that means this is the demand and this is the supply. The current composition of the workforce will have certain level of competencies. So you will have to identify them, that which all competencies are matching with what it is required. Yes, like BCP, business continuity plan. Then finally, you also need to have a bridge leader who can act. Let's say leader 1 is not acting as a leader as of now. He has stepped down. Leader 2, there is a time to come. Let's say we know that, okay, after 1 year only that leader will be able to take up. So in between, there is a bridge leader role that can be played by someone else. Okay. In terms of challenges are very straightforward. See, because startups are currently facing with the current need of how they can actually um, get their funding and all. So if they invest their time behind these things, then it will be a difficult task for them, because to invest that amount of energy and efforts. Second, the founder mindset is always there, because startup is generally the face of the founder, right? Yes, mindset of the founder. So in case you are trying to do the business succession planning for that founder itself, so that might jeopardize the overall concept of the startup itself. So there are some of the challenges of the succession planning, students. So I think this was it from the topic of startup finance. Any questions from anyone? We are happy to take it up. Let me check the query handle as well in case something else is there. There is no question there. Yeah. So I think with this, we come to the end of the revisionary aspect. I request C. Ashish sir to please help with the concluding remarks. Thank you, sir. Thank you
Thank
all.
you, Devas
Thank
sir,
you.
a lot. And session was very encouraging. And student, with this, we have come to the end of live virtual revisionary classes for that is targeted for the January 2026 examination. So in these classes, overall, what we have done, we have basically covered the overall topics in a very summary or bird's eye view, so that you can have a glimpse of the what you have done earlier. So it is just kind of a, even in a coaching classes, it is also called short fast track. This type of a batch are generally norms are used. So student, is there any numeric questions on any startup business? As such, no, Samanathan, there are no such numerical question. Of course, in evaluation, there is a startup valuation is there. So my request to you, please consider it. Okay, as such, in a startup finance, it is more or less theoretical topic. So normally theoretical topics are asked. Of course, case scenario based be on you are testing your understanding. So it is not a kind of a numerical examination question. So thank you, Devas sir, for sparing your precious
Thank you,
time
sir.
and
Thank you.
enlightening the student on this topic as well as in our previous classes. So we shall continue our and we expect the student when they sit in the January examination. So we hope that they come out with the flying colors and the
Yes.
success. So
Yeah.
thank you, student, for patient listening and making this session interactive as well. Thank you. Have a nice day. Thank you.
Yeah.
Thank you, sir.
Thank you. Thank you. Thank you, sir. Thank you. Thank you.
Yeah, session over.